Let's straight away dive in. Our team is standing by with the CNBC-TV18 list of top stocks to watch. And let's start with the good first. And kicking it off is Abhishek with HDFC Bank.
Well, it's a steady quarter for HDFC Bank in Q2 FY25 with respect to the business momentum and the P&L. The net interest margin on total asset declined by only 1 basis point sequentially. That was anticipated by analysts as well. A fee income growth that surprised positively, growing by more than 15% on a sequential basis. The slippages of formation of bad loans in a quarter that declined sequentially and was below analyst estimate as well at 7,800 crore versus Morgan Stanley estimate of 8,000 crore. Asset quality 3 basis point increase in gross NPA ratio. Now, this is despite the fact that, asset quality has remained stable, despite the fact that loan growth has been pretty weak for them. So, ROA or return on asset at 1.96% is perhaps the highest that you are seeing in last 3 to 4 quarters. The credit deposit ratio has fallen below 100% for the first time in last 5 quarters, and that's heartening to see. SDB Financial, the AUM growth is pretty strong over there at 26.5% YOY and about 3% sequentially. In terms of the P&L performance, both the ANA and PAT is a beat on our poll. Back to you.
All right, Abhishek, but we can't let you go at that. You've had a busy weekend. Tell us about Kotak Mahindra Bank as well.
A weak quarter for Kotak Mahindra Bank. Take a look at deposit growth of just 15.1% YOY is perhaps the weakest that you are seeing in last 7 quarters. Advances growth on a YOY basis is less than 15%, so it's a 12-quarter low. And on a sequential basis at less than 2.5% is perhaps at a 13-quarter low. The net interest margin did get impacted as cost of funds increased. So net interest margin has come in at 10-quarter low and for the first time below the 5% mark. Operating profits that continue to decline for 2nd quarter in a row, and for the 4th time in last 5 quarters that operating profits have declined on a sequential basis. So PAT growth is less than 5% YOY, which is perhaps the weakest growth that you are seeing in last 10 to 12 quarters due to elevated provisions because slippages increased to 1,875 crore. Analysts were pegging at 1,630 crore. So annualized slippage ratio of 1.88% is perhaps the highest that you are seeing in last 9 quarters. With reference to the P&L versus our poll, the NI is beat on our poll. However, the PAT on account of elevated provision is below our poll. Back to you.
All right, Abhishek, thank you very much for that. We'll come back to you for more because there is more as far as financials are concerned. Tata Consumer is the next one we want to focus on. Numbers. Mangalam has got those. Mangalam, good morning.
Good morning. So adding to the spate of weak numbers this time around, Tata Consumer as well. Weak numbers from the consumer space is what I'm talking about. Because if you look at it, revenues, the reported numbers were slightly below street expectations, what the street was working with. The EBITDA as well, 626 crores versus expectations of 644 crores. The net profit was largely in line, a marginal beat, but that was mainly because of a tax expense of 37 crores versus a tax expense of 131 crores. If you look at the internals, the India beverage business saw a revenue decline of 3%, a volume decline of 4%. The company attributes that to soft demand. Ready-to-drink business, which was a growth driver, actually declined by 11%, and they are saying that there were competitive pricing actions, perhaps coming in on the likes of Reliance's Campa acquisition, and growth businesses itself grew just 15% versus a 30% growth expectation. All wasn't lost. We did see some improvement in international margins and the acquisitions of Capital Foods as well as Organic Food India, but internal weakness may keep the stock under pressure today.
Okay, so not sounding too good. I mean, some of the consumer numbers and commentary that we've seen so far. Thanks for that, Mangalam. Let's head back to Abhishek. I think he's watching out for a whole host of other names as well, including L&T Finance and RBL Bank. RBL Bank as well. I mean, asset quality issues emerging there. Abhishek, take it away.
Well, to begin with L&T Finance, their AUM growth has not led to P&L growth. So the AUM growth is healthy over there at 18.2% YOY and about 4.8% sequentially. But the net interest margin has declined to 8.82% versus 9.11% in the previous quarter. Even the provisions have spiked up, by 15.5% on a sequential basis as asset quality has deteriorated with gross NPA ratio increasing by 5 to 6 basis points on a sequential basis. So the P&L, both the ANA and PAT is below our poll. Now, RBL Bank can be termed as the weakest result in the BFSI space over the weekend or in Q2 FY25 so far. So with reference to the NI and PAT, they are below our poll. Net interest margin is at a multi-quarter low, 5-quarter low, 5.04% versus 5.67% in the previous quarter. It's a sharp decline of 63 basis points on a sequential basis. Now, slippages were elevated at 1,026 crore, perhaps at a 12-quarter high with reference to quarterly slippages, and that annualized slippage ratio is very elevated at 4.67% versus 3.32% in the previous quarter. So this is at an 8-quarter high. Gross NPA ratio and net NPA ratio, they have increased on a sequential basis. The return ratios were already weak, both the ROA and ROE, so they have continued to decline, and they are one of the lowest that you are seeing in last 11 quarters for RBL Bank. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Yash. He's here to tell us about ICICI Lombard. Yash, morning.
Good morning, Nigel. So going strictly by the second quarter numbers, I'll put a red on ICICI Lombard. That's because the top line of the premium growth has been pretty strong for the company, but operational performance seems to be weakening on a year-on-year basis. So your net earned premium for the company in the second quarter, that grew by 17%. That came in at about 5,026 crore rupees. Remember, Nuvama's poll here was at 5,170 crore rupees. Underwriting loss, that went up 9%, and that's the operational weakness that I'm talking about. That came in with a loss of about 161 crore rupees versus a loss of 147 crore rupees. Nuvama's estimates here were bang in line at about 161 crore rupees. Operating profit, that went up by about 11% at 664 crore rupees versus 597 crore rupees. And importantly, combined ratio, that weakened further by about 60 basis points, came in at about 104.5% versus 103.9%. Nuvama's estimate was also about 103.5%. As I said, strictly going by the numbers, putting a red on the stock, but there's a strong positive which has come over the weekend for all general and life insurance companies. That is the GST GOM, recommending an exemption on GST when it comes to health and life insurance products. So that could be a positive for the stock today.
All right, and we'll sort of try and quantify that as well. Yash has done that earlier. We'll, of course, chat with the management, Gopal Balachandran of ICICI Lombard. You'll hear from him later at 9:50 this morning. So that's what's coming up. Well, let's move on and let's talk about Tech Mahindra, which has reported a good set. Reema is here with details. Reema, morning.
Hi, it's another good quarter for Tech Mahindra. Expectations were low, but the company has managed to beat that. So this is the second consecutive steady quarter. So good going under the new CEO. The company's top line growth, 1.9%. Constant currency revenue growth, 0.7%. High-tech, communication, BFSI, these were the growth drivers for the company. There was margin expansion. Profits went up 46%, aided by higher other income. Now, the only question is that, the company has an aspiration that by FY27, they will achieve industry-leading growth and EBIT margins of 15%. So Q1 is a good quarter. It's a step in the right direction. So the company is moving in the right direction. But will they be able to achieve this, tall ambition that they've set out by FY27? That, according to analysts, say could still be a bit challenging.
All right, Reema, thanks a lot for that. So we'll keep an eye on Tech Mahindra. Dalmia Bharat. Well, there were shots in the system getting into these numbers, and the street was sensing a weak set of numbers. And boy, weren't they weak. The sales number missed our estimates. EBITDA number as well was a bit of a miss. Margins in turn came in at around 14%. We were working with around 15%. And the profit number as well missed estimates. Now, what was good about these numbers was volume growth was a little better than estimated. It was at around 8%. That compares with 6 to 7% that we were estimating. And remember, they had that tolling pact with JP, which has now been stopped. So in spite of that, actually, they give a fairly decent volume growth, which could tell you that they pull back some market share out there. What was disappointing, though, is that realizations. That declined by more than expected. It was down more than 6% on a sequential basis. And that's the key reason that these numbers are disappointing. So sharper than expected decline on realizations and higher than expected costs caused this EBITDA per ton to come in only at around 650 rupees per ton. And if I'm not mistaken, this is the lowest we've seen in more than 5 to around 8 years, in terms of an EBITDA per ton. But we'll keep an eye out on the stock. Valuation-wise, well, it's not trading very, very expensive. On an EV per ton basis, it trades at around $90, which is not expensive. And there are a lot of shots in the system. In all probability, the street expects to see a better second half of the year. So after starting off in the red, I'll be interested to see what happens to the shots in the system.
Okay, lots of stocks with negative earnings sentiment around them. Let's go back to Rima. I think she has one more for us. India Mart, not quite meeting the cut, Rima.
Well, Q2 was fine, largely in line with expectations. 18% revenue growth, very, very sharp margin expansion. Margins went up from 27% to 38%. So therefore, profits went up 95%. But there are two, negatives internally, which makes the analysts cautious. One is the paid subscriber growth continues to remain muted. And two, collections for the company dropped in the current quarter to 5% versus 14% in the prior quarter. So these two continue to make the analysts cautious, which is why Jefferies today has downgraded India Mart to an underperform from a buy. Back to you.
All right, Rima, thank you very much for that. Well, MCX is the next one we want to focus on. Vamakshi's got details of this one. Vamakshi, morning.
Well, good morning, Prashant. MCX reported a mixed set of numbers in the quarter gone by. Revenue came more or less in line with what the street was expecting at 286 crores. But sequentially, it's a 22% uptick for the revenues. The margins, however, have come in nearly 443 basis points below the street's expectations. The street was working with a number of somewhere around 67%. But the margins this time around have come in at 62.83%. But it is also important to note that it's a sequential uptick as far as margins are concerned. They've improved by almost 627 basis points. Net profit has come in at 154 crores. This is an uptick of almost 38% sequentially and a 10% beat. So overall, the numbers definitely look mixed, but the net profit, outperformance is largely being driven by the growth that we've seen in the other income. The growth in revenue is largely being driven by the option segment. ADT for the options saw an uptick of almost 32% sequentially. Their traded clients too were up nearly 20% sequentially, so that bodes well. However, we have a note coming in from Morgan Stanley. They have an underweight call on the same target price of 3,245. They believe that the net profit missed their own estimates due to voluntary SGF contribution and provisions toward regulatory matters. They think key topics on the call will be regulatory risk and timeline of joining the news the timeline of the joining of the new CEO. The con call is scheduled today between 4 to 5 p.m. So overall, I believe it's a mixed set, but going with a red mainly on account of the miss on margins.
Okay, Vamakshi, got it. We'll keep that on the radar as well. Thanks very much. So let's quickly recap our list of stocks to watch. And hey, you only have two names that have positive sentiment around them on the back of earnings, and that's HDFC Bank and Tech Mahindra. And here's a list of potential stocks with negative sentiment around them. Kotak Mahindra Bank, Tata Consumer, L&T Finance, RBL Bank, ICICI, Lombard, Dalmia Bharat, India Mart and MCX. So plenty of red on the screen. Let's see if the stocks recover after the initial disappointment. We have now Manisha joining in. Commodity is obviously as important as always. She's got the roundup this Monday morning for us. Manisha, good morning. What are you tracking?
Well, I'm starting with an all-time high yet again in case of gold prices, $27-25 an ounce. I mean, that means that Indian markets today shortly would open at an all-time high yet again. You've seen prices gain up by 33% this year, which is the best yearly gain that you've seen in the last 14 years. So very, very strong gains continuing on to this one. But silver, not too far behind, has outperformed not just the equity markets, but gold as well. With 42% of gains in this year, it's a 12-year high for silver as well. And then the base metal prices are not too far behind. We've seen good gains onto this one. Most of Chinese data for the month of September has come in on the positive side. And the 25 basis point LPR rate cut does the trick yet again. So you are looking at stronger gains continuing for many of these metals. Copper, aluminum and zinc especially are trading quite firmly on the higher side.
All right, Manisha, thank you very much for that. So that's commodities in focus. We'll take a very quick break here, but as we do that, CNBC-TV18 is celebrating 25 years of excellence. We invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit, bringing together visionary policymakers, industrial leaders and trailblazing startup founders. This is where the roadmap for India's next 25 years of growth and global leadership will be charted. Don't miss your exclusive opportunity to be part of the conversation that is shaping the future of business and innovation. Reserve your spot today.